Jigar Mistry is now coming on our show, joining us from Buoyant Capital. Jigar, afternoon. Thank you so much for your time. Jigar, first of all, we have limited trade in the region. In the region, of course, we have large trade, but these two particular countries, Palestine and Israel, we have with Israel at max $10 billion worth of trade. It appears more sentiment than actual backed by data. But how are you assessing the overall reaction of our market today on this tragic state of affairs?
Right, Ajay. As always, thank you for inviting me to your show. See, with you on this, right, a huge humanitarian crisis, very difficult to even go through a lot of stuff that's been put out. But if you look at it from the market standpoint, there are two or three things one needs to take into consideration. One, in any escalation of the sort that we are likely to see, you will have this scenario where there will be move away from all risky assets, and which includes sort of emerging markets, which includes India, and safe havens will get bid up, like look at say gold or oil prices, which have scaled up as well. I think oil is one, a situation where you have very clearly scenario where India is very largely exposed. Unlike a Russia-Ukraine conflict, clearly you don't have a situation where the West is against the oil-producing countries here. But if the oil continues to remain elevated for an extended period, then it brings into the question the whole trade of the lower interest rates, and that is questionable again. So I think as far as that is concerned, we need to look at it. But other than that, as you mentioned, a huge humanitarian crisis, but not really very large from a market standpoint.
On this particular issue, how are you positioning right now the portfolio in this kind of a market?
Right, Ajay. So see, I think from the last time we discussed this, the situation fairly was certain that we were not very happy with the run-up sort of that the market was putting forth, especially in the small and mid-cap segment, right? With a large part of that play, the stocks were running ahead as if there was no tomorrow. And over the course of the last month and a half, he had decisively moved towards a lot of large caps and away from a lot of small and mid caps. So I think nothing changes as far as that is concerned. Additionally, we are taking a reasonable amount of time to get deployed all the incremental money that we are raising. And that continues to be the scenario. With the market correction that we get, we are happy to deploy some amount of money. But again, the focus continues to remain large caps and domestic facing themes.
That's interesting. So, this caution which you have how are you pricing it? Do you have more defensive in nature? Have you loaded on pharma or consumer, domestic consumer, avoiding IT because you don't like global sectors? Or how are you built in this caution into the portfolio, or just raise cash in general?
So one, cash obviously is a strategy, and weights is a strategy in and of itself, Ajay. But also, financials offer a reasonably decent play to, take care and take position in all the industries that we spoke about. So even if you are looking at playing the capex theme, banking eventually will see that through. It provides an incremental opportunity because the value of the banks will increase, and at the same time, the largest shareholder will be forced to sell it if it becomes a risk-off trade, right? So it's a great opportunity for investors like us to get positioned for a 2 or 3 year time frame, and that's what we are looking forward to. As we speak, consumption, again, given the inflation that we are seeing in a lot of underlying commodities, is not an ideal place. So we are not very gung-ho on that space yet. IT, as we discussed last time around as well, that it's not a place where we are seeing demand improving materially. And if factors were to play out till eventuality, then that is a difficult sector. So financials, yes. Pharmaceuticals, again, as we discussed last time around, that's a space which is very interesting. And that's where we are putting in incremental capital at work. Besides that, some domestic consumption themes like say cement, etc., is a lot more interesting as well.
Jigar, what part of the market do you find absolute good value, or are you struggling to find deep value in this kind of a market, and that's why you're taking a lot of time and choosing to deploy it, not rushing into the market?
Right. As a framework, Jai, see, what we are seeing is that of the 1250 companies, more than 500 crores in market cap, There are almost 450 companies that are up more than 50% in just the past 6 months, and 140 companies have more than sort of doubled their share price. Sort of when see India, we are with everybody that in a 10-year it makes immense sense to be in India. But I think how they are positioning that trade immediately is a bit of a concern. And it sounds eerily similar to the late 2017 sort of a time frame when 2018, with the smallest of causes, the markets for a wide majority of the number of stocks that you are dealing with found reason to correct dramatically. So, not against the way in which India is positioned, the demographic dividend, the flows, the sort of labor force participation, productivity gains, all of it point to a very stable 10-year as India as a country and equities as an asset class. But I think pricing all of it together in one go is a little bit of worrisome area, and we should be very very specific with regards to the kind of investments we want to make. The sectoral selection, the company selection within that will, I think, play a very large part if the markets were to correct from here onwards.
What is the scope purely on valuation front, Jigar? Benchmark indices, just for reference sake, or even any of the broader market indices, if you track, how much scope purely on the historic valuation metrics do you see on the table right now to correct 5, 10% or even more?
Yeah, thereabout. See, if you look at it from a broader standpoint, Ajay, what's happening is that you look at PE ratios on a 10-year benchmark, it would look like fairly decent. But then there is an argument that if the next 10 years are going to be great, then the previous 10 years numbers don't really make a lot of sense. So fundamentally, we are approaching this from a bottom-up perspective, right? Each and every company, we are looking at what the inherent reverse DCF valuation seems to be suggesting. And although, for many of these companies, the going will likely be great, the market is pricing in the kind of stuff that we are talking about. So clearly, 5, 7, 10% is something that will not be hugely out of bounds. But again, if the index corrects, say 5, 7, 10%, there will be a lot of businesses which will then be available at very attractive valuations. So it's just the positioning of the way market thinks that 10 years, because 10 years is so good, let's try and reprice all of it on one go, which is a little bit concerning. Having said that, see, old portfolios, it's not that we are sitting on huge amounts of cash per se. The new portfolios we are taking time to fully deploy, but old portfolios are at around 10, 12% cash, which I don't think is excessive at this juncture.
All right, Jigar, we'll let you go on that one. Thanks so much for your time today. That was Jigar Mistry of Buoyant Capital.